This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So as we begin our journey through the detail of leases, let's go through there and first of all have a look at operating leases. So remember, following our introduction, when we look at an operating lease, there has been no transfer of risk and reward of ownership to the lessee. So it is therefore the lessor that has the risks and rewards of ownership. So the lessor will continue to recognize the asset, and therefore the lessor will continue to depreciate that asset over its useful life. However, if we think about the lease itself, the legal form and the substance are exactly the same. Legally, it is a lease, so there are rental payments or rental receipts, and in substance, it looks exactly the same, doesn't it? Because there's been no transfer of risk and rewards of ownership. So all we need to be able to do is within the lessee's books, we need to be able to account for the rental payments, and in the lessor's books, we need to go through there and account for the rental income, isn't it? The key issue is that when we're looking at the rental expense or the rental income is how to go through and calculate it. It is calculated for the same way in the lessor and the lessee's books. Okay, so what we go through and do there is we go through, don't we, and we take, is it the total payments made over the lease, and then divide that there by the lease term. So do just go through that and be careful when you're looking at the total lease payments. That looks at just not the annual rental payments, but also any deposits that may be made as well. They are incorporated into the value of the lease. Once you've done that, you divide that by the lease term, and that works out as your annual expense. And then when you record that expense, there will then be a balancing figure within the statement of financial position, because what we have paid may not necessarily be exactly what has been expensed in the statement of profit or loss or recorded as income if you look at it from the lessor's books. So what we're going to do is we're going to look at it from the lessee's books first, because that's what we've seen in F7, and then we'll flip it round and look at it from the lessor's book. So here the question does say explain how both Banana the lessor and Mango the lessee would account for the lease in their respective financial statements. But what you've got here is that there is a 4-year operating lease. The terms of the lease are that there are lease rentals of $2,000 per annum in arrears. We're not too worried about things being in arrears or in advance just here. We're just looking at recording the expense. The key bit that you've got here now is that there is a rent-free period in the first year. So there are 4 years worth of the lease. We don't make a payment in that first year, so we actually only make 3 years worth of payments. So to work out, if we look at, shall we say, the lessee's books, then what you've got there is that the expense is 3 years at 2,000 divided by the 4 years on the lease. Does that give us $1,500 per annum? Okay, so in the lessee's books, the person who is leasing the asset, we have $1,500 as an expense. Now, if we go through there and look at the journal entries for what happens is it in year 1, well, we need to recognize an expense, don't we, in the statement of profit or loss as $1,500. If we look at the credit, we can't credit the bank, can we? Because we've not paid anything. It's a rent-free period. So we have to process a credit of 1,500, don't we? But that credit is to an accruals account because we have accrued the expense for the year. If we then go through and look at it for the subsequent years, so let's just have a look there. Is it at year 2? Again, we still need to recognize an expense of 1,500 because that's the same expense every year for the 4 years. We then credit the bank, don't we? We credit the bank with 2,000 which is what we pay at the end of the year, because I think it was in arrears. What you've then got there is a balancing figure. That balancing figure is 500. And what you are doing there is you are releasing that accrual of 1,500 over the final 3 years of the lease. Okay, so you release 500 in year 2, 500 in year 3, and 500 in year 4. So the journal entry for year 2 is repeated in year 3, is repeated in year 4. Okay, if we go through there and look at things, is it then from the lessor's books? Then it was an expense in the lessee's books. It's now income. Is it there in the lessor's books? So you are going to credit your rental income. Is it with 1,500? And you need to process a debit, don't we? That is equal to the 1,500. What you've got there, that debit would be there as your accrued income. It's like an other receivable, effectively, isn't it? Of that 1,500 that you're going to collect over the next 3 years. So what we then have is it there in year 2. If we look at year 2, again, every year we still need to credit the rental income, don't we? With the 1,500. We can now debit the bank because year 2 isn't a rent-free period. So we debit the bank with the 2,000. You can see clearly that it doesn't balance, but what we do is that we then credit your accrued income with the 500. So again, releasing that 1,500 as accrued income over the following 3 years. So that there is $500 per annum. And what you can see there is that if you look at the treatment there in the lessor's book, which is new, that's different to what you've seen from F7, where you just looked at things in the lessee's books. It is essentially the reverse, isn't it? It is just the mirror image. Okay, that's it. You just reverse the debits and the credits, but just be careful. When you're looking at it from the lessee's books, you will have either accruals or prepayments. When you're looking at it from the lessor's books, you're going to have either accrued income or maybe deferred income. Okay, so rework that example, make sure that you are happy. One of the issues that you do have, which is why there is a new accounting standard that it's not yet included within the syllabus. It's there as IFRS 16. It's a new standard that is coming into effect in the future, and it will appear in the P2 syllabus in the next syllabus change. But one of the big issues that you've got, and one of the reasons why that the standard has changed, is because if you go through there, and let's look at it from the lessee's perspective. Now, the issue that you've got there with the lessee's perspective is that at the end of year 1, you know that in the next 3 years, so years 2, 3, and 4, you're going to have to pay 2,000 for each of those years, aren't we? And the issue that you've got there is that you have an obligation to pay that money because you've signed into a rental agreement, but there is no obligation on the statement of financial position, is there? Okay, you should be showing an obligation, shouldn't we, for the amount that we owe under the terms of the lease in the next 3 years. The definition of a liability is a present obligation as a result of a past event that gives an outflow of economic benefit. Well, we have a present obligation because we've signed the contract. We know how much we're going to go through and pay. That will be the outflow of economic benefit, and we can measure it reliably. But we haven't recorded a liability or any obligation on the SFP. So that gives us a little bit of a weakness with regards to the accounting standard, because it doesn't match up to the definitions that you have within the IASB framework of the elements of the financial statements. So there is a little bit of an issue. Again, if you think about it as well, we're not just thinking about it as an obligation, think about it as an asset and something you control. You are the lessee. Yeah, you've entered into a contract to use that asset over the next 4 years. It's yours to use for 4 years. So you are controlling that asset. There's no restrictions on how you use it. So again, surely is it not therefore once again your asset? Have we recognized an asset? No. But do we control that asset? Yes. So again, there's a bit of a breakdown in terms of the rules and the standard and our underlying principles to do with the elements of the financial statements. But we'll save that for a rainy day. Yeah, that's a likely current issues question, and you never know when that could get examined. But just be aware, yeah, that there are issues surrounding the leases standard, particularly first of all when it comes to looking at your operating leases. So we've gone through and looked at operating leases. We've looked at it from the lessee's perspective. We've looked at it from the lessor's perspective. It's nothing too challenging. It's just the mirror image of the accounting treatment that you saw at F7 for the lessee. In the next session, we'll go through there and begin to up the stakes as we go through and look at finance leases for both the lessee and the lessor. I'll see you next time.